So when I look at someone's couch, there's going to be a handful of things that I look at, and we'll go over these all in this video. We're going to go over fees, overlap on individual holdings, risk. Are you taking too much risk? Are you not taking enough risk? Are you in a comfortable risk portfolio for what you like to see? Over diversification. We've heard this many times on social media, the news, etc. You need to have a diversified portfolio, but most people don't realize they are technically over diversified. Tax efficiencies. A lot of people's accounts don't carry the tax efficiencies that they're necessarily aware of. And then lastly, not really having a clear strategy. What that means is what you're investing in may be working fine for you, but how can we make this work better for you going forward? So let's dive in. One of the first things that I always look at are fees on someone's accounts. If they are inside of the 401k or an old 401k, I'm going to look at the underlying mutual fund expense ratios on there. What those expense ratios are fees that the mutual fund or ETF carrier has built in to cover their trade costs and their expenses for managing that specific fund. Now, how those are typically deducted from the fund are from the growth. So if that account were to be up, call it 10% in 1 year, if there's a 0.5% expense ratio, you're only going to see a 9.5% return. Typically, they don't have to disclose what these expense ratios are, and they can often change. So that's one of the first things that I look at. Now, if it were to be an advisory account with another advisor, I'm going to try my best to do the backwards math on figuring out what their fee is that they're paying. That's usually going to account for some sort of advisory fee, or that's going to be some sort of fee to the advisor. A lot of what I see is about 1%, but advisors can charge up to 3%. Inside of all of those advisory accounts, there's often sub-account fees as well, with the expense ratios tied into some of these mutual funds and ETFs. There's platform fees, so the type of advisory account that you're in, the custodian or back office is going to have a fee on top of what the advisor is charging. And then if you hold any mutual funds or ETFs inside that portfolio, more fees on top of that. So a lot of times what I see is people in portfolios that it's a mix of mutual funds and ETFs, and they can see the fee deducted on a statement, but they may not necessarily see all of the fees because of the platform or expense ratio that are taken out of these funds. For some clients that may own an annuity contract, there's often fees associated with those as well. There's going to be rider fees. Some contracts just carry a standard fee. There's mortality and expense ratio fees. So annuities can sometimes carry some higher fees depending on the type of annuity contract you have. A lot of this stuff also is public information. You can look at the funds that you own. You can look at the annuity contracts you own, and you can go to certain websites, and I'll attach those links down here at the bottom, and figure out what the fees are associated with those. So the second thing that I see a lot in people's portfolios when it comes to owning mutual funds, ETFs, are overlap in holdings. Now, many people think if you have a portfolio that has mutual funds and ETFs, you're looking at a diversified portfolio, but take a look at each one of those holdings. Or if all of your money is sitting in what's considered a target date fund, which is a fund of other funds, look at what those underlying holdings are. This is all public information. You can pull them up online and see what the top holdings are in each one of those. Anything with large cap or S&P 500, those are all, for the most part, not saying every single one of them, but they're going to have a lot of the same holdings. There's going to be a few here and there that are off. Ultimately, what that does is you're paying expense ratios on all the funds to have the same stock. And one fund may have a little bit of a different investment objective than the other fund. So some of the top performing stocks that are inside of these portfolios, one company may be selling, one company may be buying, and one company may be holding them. So there's just a lot of different conflicting strategies that, working with someone like myself, is I can design a portfolio that fits exactly what you're looking for. In those type of stocks, we're going to go over exactly what you have, because the biggest picture that I always tell my clients is I want people to know what they own, and having some of these overlap in holdings doesn't necessarily always work in everyone's favor. Another component on overlap is for the bond holdings. Now, there's not necessarily going to be overlap in the exact same type of holding like it would be in the stock portfolios, but what you can see in the bond portfolios a lot, some of these fixed incomes, is they're going to own a lot of the same type of bonds. They're going to own a lot of like U.S. Treasury type of bonds. There's not going to be a lot of mix. So if you look at the percentage of a fixed income mutual fund or bond mutual fund, you may see a high percentage sitting in U.S. Treasuries. So I'm not saying there's anything wrong with owning a bunch of U.S. Treasuries, but there's a lot more options available out there that you can explore on the fixed income side. Third component that I look at is risk. A lot of people may not understand what their risk makeup is on their portfolio. I typically use a scale from 0 to 100. It's kind of almost like an industry standard. The zero risk score is basically going to be having hard cash like you have sitting in your wallet. There's no risk to losing those dollars due to market fluctuation. And then you have the highest risk associated at 100, and that's going to be some more complex derivative type of investments. So we're not going to dive into the hundreds, but when you get into the upper 80s and 90s, that's going to be mostly a stock, either U.S. and foreign stock portfolio. So when I sit down and look at someone's portfolio, I'm going to look at the percentage of stocks in their portfolio, the percentage of bonds or cash or fixed income, things like that. Some of these pre-built target date funds, some of these asset allocation type of funds, they're going to carry their own year to year, month to month type of risk, and they may adjust those accordingly. But a lot of my clients are unaware of what that mix is. When it comes to risk, I usually look at the 3-bucket approach: now money, later money, and never money. When you look at those 3 types of buckets, that's kind of where it helps me define and help a client associate the risk level that they need. Because every client has a different risk level that they can tolerate and a risk level that they are probably potentially needing to achieve their goals that they want. So looking at those 3 buckets makes a big difference on how to associate certain types of money, whether it's cash, Roth, IRA, but also understanding that if the more risk you take, the higher reward long term historically, and less risk is lower returns, and that could potentially affect the goals that you want to achieve later in life or even now. So it's always really important to understand the risk, and what people's portfolios have or what people have in their portfolios may not be exactly where they want to or technically should be. Another thing about risk as well is how much of the portfolio is growth, how much is in value, which is going to be more dividends, steadier paying stocks, or dividend paying and not as volatile to current market conditions, and then cash, bonds, things like that, and understanding the purpose that each one of those serve in someone's portfolio. The next thing I look at is over diversification. Now this kind of ties into the overlap of holdings. What over diversification is very similar to having stock overlap. Having 3 called large cap growth type of funds. So each one of those funds may hold anywhere between 100 and 1,000 different stocks. So you're only owning a sliver of each one of those stocks in the underlying holdings. As I stated earlier, being diversified across the different type of asset classes, whether that's, large cap growth, value, international, small, mid, bonds, things like that, the different types of bonds. What I see a lot is people being spread across way too many of those, and it kind of ties into the overlap. If you own 5 different types of large cap growth or large cap blend per se, something along those lines, you're just owning little tiny pieces of those stocks. If you look at what the holdings of those individual funds are, your total positions are going to be in the thousands. So it's really hard to capture all of the market gains when you own everything. And essentially that's kind of what happens is you get a few pieces here and there of all these different stocks, and there's so many holdings on the bottom half of them that kind of can drag down returns. As far as the fixed income portfolio goes, there's all of bonds and fixed incomes available in the open market than there are individual stocks. So what we often see is, instead of being overlap necessarily in these fixed income funds. There's just a ton of holdings. If you're sitting in a fixed income fund, go take a look at what the underlying holdings are and how they're in the thousands. And they're spread across so many different types of durations, different types of bonds, whether it's corporate, municipal, treasuries, short-term, high yield. There's different types of bonds. It's spread across all too many of them. So effectively what happens, it's hard to create gains in the portfolios when we own that many of them, spread across all different types of bonds. The next thing you look at is tax efficiency. Now, first off, retirement accounts don't necessarily need to be tax efficient when it comes to the investment portfolios. There needs to be tax efficiency at some point with these and understanding, certain times to take distributions, not contributions, etc., where we're tax efficient kind of on the back end and around those types of accounts. But when I see a cash account that is subject to tax every year, depending on any dividends, interest, or capital gains that are paid inside there, there's a lot of moving pieces inside a taxable account. So what I see a lot with funds in general is they tend to have more turnover than what you can have in something that in portfolios that I tend to use for clients that have these taxable accounts. Most of the time, we don't want to be creating large capital gains for clients. It's just more taxes people have to pay on a year. But ultimately, depending on what your goals are and where your current overall financial plan is, dictates that. A lot of these mutual funds, not necessarily ETFs, but a lot of mutual funds have a high turnover. They create a capital gain every year. Ultimately, to be tax efficient, we take a look at your entire tax situation, but also understand that, what types of investments we pick are going to affect you now and later. So when I'm reviewing someone's portfolio that has taxable accounts, is we want to account for all of that. We want to account for not only just the taxable, the Roth, traditional. I take a look at everything, because big picture, it's not necessarily what you earn, it's not necessarily what you invest, but it's all about how much you keep after taxes. And then lastly is just really having no clear strategy over the course of time, whether it's in 401ks, do it yourself or other advisors. So a lot of these funds and pre-built portfolios and things that people have, they just randomly are added over time. There's no clear strategy on what to do. I see there's really no reason behind these allocations. There really hasn't been much of a risk profile created or maintained over the years. For some people, as we dive into the risk association, is let's put a plan in place. Let's understand that the type of money that we need now, later, or never is going to affect how we invest it, and kind of put a whole plan together. All this stuff ties into the big financial plan that I do for clients, from estate planning, tax planning, risk management, which is also insurance, income, and then investment. So everything is all tied together. So I'm going to design portfolios and manage people's investments based off their goals and how it fits their financial plan, and then what risk level that they're associated with. Because when I take a look at someone's statements, a lot of times there's one or a few of these things I covered today that people haven't paid attention to. So just a quick recap on what I do when I look at someone's portfolio is I'm going to look at the fees, what they're paying, what they see, what they don't see. I'm going to look at the overlap in holdings. If, you have a S&P 500, large cap value, large cap blend, what holdings in those accounts are going to be the same across the board. I look at tax efficiency, making sure that we have a game plan on what we're doing on the account. We take a look at risk, understanding that people may be over or under risk on what they are comfortable with or what they need. Over diversification, do they own too many stocks across all these different funds and things like that? And then lastly, is there an actual plan behind it? Are we just trying to throw something at the wall and hope it sticks? Or are we going to put a game plan together and make sure that this works exactly for you and for what goals you want to achieve? So ultimately, I'm not saying that every portfolio that I review is necessarily terrible. I just take a look at how I can fit this into their financial plan that is more based on what they're looking for, what their goals are. For a lot of people that I work with, their previous plan has worked. They were good savers. They made some sacrifices to save, and some of these portfolios did perform, and they do. But as you start to dive into more of a complex financial plan, it makes sense to look at your investments and figure out how are these actually working for me, and can I do a better job of making these fit my goals? So if you own more than 15 funds, it's probably time to take a look at what you're holding. A very common mistake I see in people's portfolio is just there's no plan. It's put together, it's been working fine, but there's nothing beyond what they're currently doing. People make tax mistakes all the time, and they can cost them thousands of dollars. If we're using the account to pay taxes, we can save money, ultimately have the portfolio perform better if we're not having to use it to pay taxes.
If you'd like to learn more, you can go to my website, financialplanningwitheddie.com. You can also schedule your free initial consultation with me on the scheduling link. Hope you enjoyed the video. If you did, please like and subscribe, and follow me on Facebook and Instagram, Financial Planning with Eddie.